Good morning, everyone. I am absolutely thrilled to be able to present this conversation this morning on the investments in innovation, where we're going to actually take what Gumil just spoke about and probably take it a little bit further. I don't think it's too contentious to say that there's a lot of opportunities for larger corporations, startups to collaborate to drive innovation and change. I think the trick or the challenge is, how do you get it right? How do you use best practice to guide your relationships? And how do you maximize the benefit? So we're going to dive into that a little bit more today. So I am Andrew Matuszak. I lead KPMG Ventures. And I am joined here by Scott and by Trevor. Trevor is I'll say, entrepreneur, investor, and diplomat. Trevor has founded and sold 5 companies to the likes of Microsoft, Intuit, and MasterCard. In addition, he has a new venture, Kresus, which is looking to bring crypto and digital wallets to the masses and make it accessible to all. So I'm excited to learn more about some of the innovation both at Kresus as well as some of the past companies. And we've got Scott. Scott is the president and co-founder of Touchdown Ventures. Touchdown Ventures is the pioneer of venture as a service, the largest such company in the world. Over half of their clients are Fortune 500 companies helping to stand up, create, and run corporate venture capital programs. So Scott just brings such an incredible perspective on how large corporates can work with startups. Now, in my experience, or I'll say over the last few years, I think kind of to tee up this conversation, what I've seen is just this remarkable shift, kind of what Gumil is talking about, and certainly what we're going to get into in a little bit, is this shift from the perception and use of corporate venturing. It's no longer seen as just, or hopefully no longer seen as just some subsidiary or secondary source of funding. And I think in some cases it's evolved to be an indispensable tool for helping catalyze groundbreaking innovation and research, and doing so by bridging the gaps between large corporations, dynamic startup ecosystems. In addition, I do think that corporate venture capital has become, and I think Camille kind of hinted at this, it's become increasingly essential to the overall venture ecosystem. The old opinions of corporate venture capital as being opportunistic or sporadic has begun to change, and I think recognizing that well-run programs can offer a lot to a startup, much more than just access to capital, but an immense wealth of industry knowledge, access to an expansive new network, as well as some market insights that are fairly unique. So speaking of insights, what I'd like to do is kind of jump right into this. And Trevor, if you don't mind, I'd love to ask you the first question. So just given your background, first of all, it's absolutely fascinating. And I forgot to mention, besides tech, Trevor is also an owner of a vineyard, an avid art collector, and I did mention, but Trevor served as most recently as the United States ambassador to Austria. So incredible background. Would love to hear a little bit more about that, and especially kind of, through your 5 companies that you founded and sold, as well as Kresus, how do you think about innovation, and how do you think about working with some of these larger companies?
Well, first of all, thank you for having me here. It's a pleasure. As I step outside at 8,000 feet with mountains and this summer weather, it actually feels like we're back in Austria. A little bit at least, but I'm a typical born and raised Bay Area, Silicon Valley dude who started 6 startups and also took a detour as United States ambassador. You'll meet many of us, but to your question, every one of the companies that I founded had corporate venture capital in them, alongside regular venture capital. So over the previous 5 companies I sold, I had money from GE, Intel, Hyatt, Advanced Newhouse, Sotheby's, MasterCard, American Express, you name it. I mean, across the board. But I think everyone has to be sort of clear-eyed about how it works. My new company is called Kresus, and Kresus is really born out of the realization that the blockchain and smart contracts will affect every one of you and all of your businesses. It doesn't matter what you're doing. It's such a profound innovation. Forget about, Dogecoin or speculative NFTs. This is the underlying technology. And so it's a B to B to C company that is going to, partner with big businesses and help them. And in the case of Kresus, we have investment among our other venture investors from Franklin Templeton, as well as JetBlue Airlines. So businesses that realize that they're going to have to understand this whole blockchain thing, and they need to make bets.
Yeah, perfect. Thanks, Trevor.
Trevor, quick question.
Yeah.
In your prior businesses, did any of those corporate VCs actually wind up acquiring the startups?
Yes. So in my last company, MasterCard was one of my investors and ended up buying the company. And I spoke 2 weeks ago with Raja, the CMO of MasterCard, and he said, I have to tell you that If Only, which is the company they bought, powering our worldwide priceless program, said it's such a spectacular home run what we got, from that. And so it really can be transformative to a big company.
For you and for them. But
For
it was
both.
one of 6.
That was one of 6, yeah. And my first company, I sold them to Microsoft. I sold the company to Intuit. So it tends to work out.
Yeah. But interesting expectation setting for whether the CVC is going to wind up acquiring its portfolio company.
Yeah.
That's often one of the big questions.
Often.
Yeah, I mean, and Scott, just from your perspective, and it's first of all, just an incredible point of view that you have on this, right? So managing such a large number of corporate venture capital programs means that you have access and insights into all of this, as well as all the portfolio companies. And, if we were to use maybe like Gumil's sports metaphor a bit, right? Like, from your perspective, what are some of the things in terms of, where companies were? I mean, the nexus or the genesis for why you founded Touchdown is kind of the reason why we're all here.
It's funny because we called the company Touchdown, but I like where Gumil went in the last conversation where he said, okay, if this is a sport, what level are we playing? And I think, he held out Olympic as the standard. And I would actually pick a different standard. I would say, I was thinking about the NBA. We just had the NBA Finals. And I've been watching this documentary called The Last Dance about Michael Jordan and the Chicago Bulls. And early on, I don't know, has anyone seen it? It's really worth watching if you want to, be a champion, I think, is the mindset. And he gets really bent out of shape with management. And they want him to tank. They want the team to get a lottery ticket. And he goes ballistic and he says, we're going to play to win. And all of the people who were reporting on what happened said they violated the fundamental rule, which is you're going to play your hardest at the highest possible level and you're going to play to win. And so I would say, that should be the mindset for corporate venture, which is, you talked about how mainstream this is now. In most years, it's 25% of all deals, it's 40 to 50% of all money. This is a huge part of the market.
Yeah.
So play to win, play like professionals. That's really what drove us to start Touchdown, is that with 100 new CVC starts every year, there's a portion who are going to say, we're not playing around at this. We want to do it the right way. Kind of the experience that you had.
And not all are playing at the Chicago Bull level. I mean, what was the stat on how many CVCs, what's the average length of a corporate venture capital program?
Yeah, NCI did a survey, and the average CVC program is shut down in 4 years, which is a depressing stat when you put it up against the fact that the average venture returns take 5 to 7 years. So clearly the organizations are not waiting to find out whether the deals are good. They're just getting impatient and pulling the trigger on average. And so you can't, just like in regular venture capital, I don't know, people know the stat, the average venture fund returns 1.3 times the money in 10 years. So, the spectacular numbers that Gumil showed are for the good performing funds. And so if you're going to be average, it's no good. If you're going to be average in corporate venture capital, you're going to be out of the business quickly.
So Trevor, kind of going back to some of the experiences, and especially since some of the corporate venture capital and big name corporate venture capital units programs invested in your company, tell us about what are some of those insights that you've gained, sitting on the opposite side, right? So I think what's so interesting is you and Scott bring this opposite perspective, right, of sitting across from the table. As you were sitting across from the corporate venture capital programs or these large corporates, what worked really well? What were some of the things that you liked about that relationship?
Well, I'm a huge believer in corporate venture capital, and I've seen it be really powerful and effective. But, I mentioned before you have to be clear-eyed about it, right? So I think the company needs to be clear-eyed and the entrepreneur needs to be clear-eyed, right? Because entrepreneurs see these big companies and they go, woohoo, it's either money or an audience or something, right? But the signing of the investment is only step one. As an entrepreneur, then you spend an incredible amount of time, convincing, meeting the different groups in big companies and re-explaining why did the company make the investment in the first place. It's not like the barn doors are open. It's hardly that. It's actually like a daily slog to work your way through the organization, to build champions, to learn how to unlock value. It takes a lot longer than you might think. But if it's done well, it can be incredibly powerful. And from the flip side, I think that these big organizations need to be clear-eyed about what they provide and how they're operating, right? So with very few exceptions, a big corporate investor is not Mayfield or Sequoia or Benchmark. You're playing a different role, so your expectations have to be different, right? What you can ask of the entrepreneur, et cetera, is different. And you really need to try to set that entrepreneur or team up for success. So the ones that really think through post-investment, how do we introduce them around our organization? How do we help find them advocates within the organization? What are we trying to get out of this? Like, what does cross-pollination look like? What could be the benefit to us? Thinking those things through in advance really is powerful. So I've had corporate investors who do, dedicated portfolio days where they bring, American Express, they had the CEO and the senior executives and the portfolio companies for 2 days. And we all presented, what do we do? And the CEO on down listened and talked about, let's introduce them to these guys, or we could do, they took it very seriously. And that's an example of success, because for a small company, a large organization can be very daunting. But I could say with conviction that every one of my corporate investors got something awesome out of the relationship, either cross-pollination, learning a new technology, or in some cases the whole company, right, as a platform. So but I think kind of thinking ahead, trying to map out a strategy, trying to map out what would success look like, and then working, checking in quarterly or more. How are we getting closer and closer to that?
So just as a follow-up to that, because I think it's one of those things that either takes experience to learn to do this right, and usually hard fought lessons. How important is it to do some of that work up front prior to committing through the investment itself? Like, how important is it to make sure that the relationship, that you're going in clear-eyed prior to signing the paper and then figuring it out?
Well, I think it's important. And so the venture team within the company, the corporate venture team, they need to straddle the middle, right? So they have to be kind of dreamers and believers, because they're always going to be out in front of the main organization, but they can't be so far out in front that they no longer have connection. So in the case of my new company, Kresus, right? So I'll give you 2 examples. We have an airline and Franklin Templeton, major financial firm. Both of them realize that their businesses are going to migrate onto the blockchain. So in the case of JetBlue, loyalty points, ticketing, all these things will inevitably be on the blockchain because it's better, right? Yep. Franklin Templeton already been dipping their toe in moving financial products onto the blockchain. So they're looking at Kresus and saying Kresus is a platform. These people are not crypto bros on an island hiding from tax authorities. They're legitimate, seasoned. They straddle credibility in Web 2, but knowledge of the blockchain. So they can be our guides, help us put together our platform, help us put together our strategy. So up front, they sort of set out, well, what does good look like? Who do we introduce you to? JetBlue had a portfolio day, brought me in, talked about how they work, and that's kind of what a best practice looks like.
Yeah.
I'll often describe what we do as being diplomats between the large corporation and the startups because they speak different languages. So I was really excited to meet you because of your background. How much overlap would you say you see in the corporate ventures team, given your experience as a diplomat?
A lot. So, I mean, being a diplomat it's a special set of skills. But it was funny, being a diplomat, being a United States ambassador, I had a large embassy, 400 people, 13 government agencies who reported to me. Plus, I had to go through a Senate hearing, be confirmed, et cetera.
Yeah.
But it's funny how things like OKRs and media training and all those things that I had from being an entrepreneur helped me in being a diplomat. It's, at the end of the day, really kind of common sense. And in the CVC world, right, you have legal and all of that. Then you have the business groups that have goals, probably senior executives who have ambitions to be more nimble, and then the bureaucracy that are fighting it, right?
Yes.
In my first job, they passed around a cartoon, a board meeting, and one of the people's reading the card, and it says, "Season's greetings," and he says, "Seems good, but who ran it by legal?" And that's sort of like what it's like when you're the portfolio company, in a big company.
I think there's huge underestimation of the fact that these organizations speak different languages, have different objectives and timelines, and are good at different things. And so, if you could leverage the strengths of each, it's a win-win. And if you're just talking past each other, nothing happens.
And the good CVC people already know where the stumbling blocks are going to be, and they're sort of saying, you're going to have our legal review, you're going to hate them. Here's what's going to happen. They're going to ask you these things. There's going to be some insurmountable obstacles,
Yes.
and then we'll meet after and we'll surmount them,
Yes.
right? And then we'll get you to the next stage.
And Andrew, you asked the question, how much advanced preparation work should you do to set that up? What we found is that it's different for every corporation. And so when we set up a new CVC fund, we measure the culture of the big corporation and say, what are you like? What are your needs? What are you used to? What's comfortable? What's uncomfortable? And it's really interesting because they're all different. And there's no two people are alike, no two corporations are alike. And so we have some that I would say are very liberal in terms of how they set these relationships up, where this thing's in scope, it's strategic, let's go do it. We'll figure out the commercial or strategic relationship afterwards. But we kind of have an idea of why it's relevant, and that's good enough. We think it's a good investment. And then there are others at the very far end of the spectrum that say, if we don't have a demonstrated pilot that succeeded, that we know that we're going to expand, we're not going to invest. That's a strict requirement. And then most are probably in the middle, but they're all over the map.
How, that's interesting too, because I think, getting to the philosophy of like why you're doing this and your culture, one of the things I always thought was interesting is the point that you have about balancing between strategic objectives and financial. Can you give us a little bit more background? How do you approach it? How do you coach your companies to be thinking about where they fall on that?
It's this, I think it's this incredible false Sophie's choice that you have to choose between being strategic and being financial. And there are a variety of reasons. If you study the venture capital industry, since the 1960s, and some of the first VCs were actually corporate, how did this all emerge? And then what happened with the rise of tech players in Silicon Valley, like Intel and Intel Capital? We went through a wave where traditional VCs, and I was one of them, you gave me flashbacks to CalPERS doing diligence on us before they funded my first institutional fund. It was don't work with corporates, don't work with strategics. The idea is that strategy would be negative, and that there would be toxic terms like the right to buy your startup that would prevent the entrepreneur and prevent the other VCs from making money. And so that was the advice that I got from Tim Draper and John Fisher when we started DFJ Frontier. Don't take money from a strategic, they'll mess up your deals. We have to be good financial fiduciaries, so we get invited into these deals. We have to be good stakeholders. And so they went through this period of time where they said, we're gonna be financial only, just like you. And it was taking the very best part of what they could do for a startup and cutting it off and sticking it in a closet. And it was just mind-blowing, but that's what they had to do to rehabilitate the reputation of corporate venture. And then, in probably the early teens, corporations realized, actually, strategy could be good. We could help our portfolio companies. We could have demo days. We could make introductions. We could become a customer. We could be distribution partners. We could help you make your science better. All of the things that a corporation can do to accelerate the growth of a startup.
I feel like any large organization would be foolish not to have a venture arm, because any large organization de facto is not going to be nimble enough to pick up on latest technologies, and probably real innovators and dreamers are not going to be interested in working for them. And so it is the easiest and best way to pick up that part of the dashboard that they're not going to have otherwise. It's just a no-brainer. And all of my venture investors from corporate got both DNA and made profit. So you could certainly have both.
Yes.
Innovation that pays for itself, right? Through a good, well-run program. I think that's one of Touchdown's key tenets.
Yeah.
So, thinking about, moving a little bit to some trends, just especially given Kresus and what it's trying to do, and Scott, I want to hear from your perspective as well, is, where do you see right now ripe opportunities for startups that are solving some problems where, where do you see startups focusing their energy? What business challenges do you really think are they're putting their time, energy, and sweat into to try to solve?
Well, when, like we were hearing in the last presentation, I think now's an incredible time to build a company. Venture, like particularly Sand Hill Road type venture, just like any other industry, tends to whipsaw around what is the latest trend. A year ago, they couldn't do enough blockchain crypto investments, and now they can't do enough AI investments. And tomorrow it'll be something else. But fundamentally, I don't think we've ever had more platforms right now. So, when I started my career, we had the PC, and then it was the internet, and then it was mobile. But now, you have the metaverse, you have the blockchain, you have AI, you have mobile, you have all these things, and they're all going to change how, everything, right? And they're going to be interesting startups working in all of those areas. The first thing is ignore the headlines in the Wall Street Journal about what's in or what's out. Look at what's real. It's like, I love building a blockchain company right now because it's crypto winter. It's a golden opportunity to build something enduring, because I know the blockchain will affect everyone's business, right? And so look at what are these legitimate platforms that are emerging, and look at who's innovating there. And also, look at who can speak corporate and dream.
Right.
Because you can either end up with those dudes on the Caribbean islands who, will never be good partners because they don't have the patience or the intuition to understand what's going on in the big enterprise. But similarly, don't hire people who only have been senior corporate executives and think they're going to start a small company, because they can't dream.
Right.
You need a little bit of both.
You need the collaboration. I wanted to get your opinion too. I thought that one of the things that Camille brought up that I thought was really interesting is when the startups and the larger organizations begin to collaborate. And I think, it's obviously very, it's particular to the organization, et cetera, but it's a great point. From your perspective, having founded these 6 different companies, where do you like the corporate to come in and start to add, start to do some of those things that you said? All the way going back from idea, pre-seed, all the way to seed, Series A, et cetera. And I think one of Camille's points was that the corporates coming in later added a lot of value. What's your perspective on that?
Well, I think corporates come in early, and they should, right? Because it's not even just about shaping. It's like, by the time it's late, you're going to be one of 20 big investors in the company, and you're not going to get the time or the attention of the dreamer founder, right? Whereas early on, you'll be really important to that founder or that team, and they'll put a lot of energy and effort into working with you because they'll be trying to unlock that value. You'll never have more access or importance. And I also think companies that are honest about their challenges or their weak spots, or those are the ones who will benefit from the creative thinking of the investment company. I've worked with a big for instance, I sold one company to Intuit, and they were best known for tax software, but they had point of sale software for small and mid-sized businesses, and they were trying to figure out how to sell that and how to promote it. And that was a challenge. I've worked with other big, I don't want to name names, but where you could see credit card companies where the programs that had worked in the past were no longer attracting people, and they needed ways to burn points or new ways to, and we had creative solutions. So the more honest they were about where are we soft, the more we could step in and shore them.
Which is hard to do emotionally, right? I mean, Camille, when you made that comment, I actually took a note about it because that's not true for us. For the 20 plus corporate funds that we run, we say that they're all stage agnostic, industry focused. I would say the bulk of the investments are actually early stage. And we'll define seed, early, and growth as seed is your product isn't out in the market yet, early as it's out, you've got some traction, some revenue, customers we can call, and growth or expansion is now you really understand your business and it's predictable, and if we put capital in, we'd know what would come out the other side. And what's interesting is we do a little bit of growth and we do a little bit of seed, generally speaking, but a lot of early. And I think it's for the reasons that you just said, Trevor, which is this is the time when there's enough there from the startup that there's something to do, but it's not so far along that it's kind of passed us all by. And I think that's an interest. But on the other hand, we just put $3 million in a $150 million Series F pre-IPO round last year, where they said, look, you guys are more than just a check. We want you in. We'll expand the round to include you. And then there's some times when we say, here's something, it's at the science project stage. It's so strategic for both of us. Let's take the risk, even if it's 1 out of 100 or 1 out of 1,000 that it works. The financial return and the strategic return make it worthwhile to do it. So it goes back to something else that you said, which is why are you doing it? And if you know that, then you could decide what tactics to put against the deals.
I feel like we should have Camille come up onto the panel.
Exactly. There's a
going.
chair.
So we only have about 6 minutes left, and there's a lot of stuff to cover here. And just the experience that's up here on the stage is incredible too, just to be able to tap into it. Trevor, kind of thinking about. Sometimes it's great to hear about what worked really well, the portfolio days at American Express, the interaction with the top level management, which I'm sure drove action at lower levels. Nothing drives action like the CEO giving direction. Sometimes, at least for me, I think it's helpful to learn from examples of things that didn't work well, or looking back on it, whether it's earlier days or just different iterations of. What were some of the things that didn't work well when you were working with a large organization, even obviously, and ending successfully, but what were some of those things that you would say we could all learn from to say, avoid this if you can?
No, I think that what can happen is, particularly for larger enterprises, you as the portfolio company can get orphaned, right? Where you kind of you get a very limited hunting license, where it's sort of like, talk to so-and-so over in division such and such. And so doesn't know who you are, doesn't care, doesn't know why the investment was made, doesn't have much authority or incentive, right? Yeah. Whereas a better model would be to say, where's 5 places where we could insert this investment into our organization? Let's pick 5 people who are their point people, and let's incent those people to success. Either, a bonus, a whatever, maybe some carry on the company itself, or let's make it their problem, and let's pick people who are sanguine enough that they know how to speak company and speak startup both. Right. Because you have to go hunting everywhere to find value,
Trevor, the CFO of one of the Fortune 500 companies that we work with when we were kicking off said, when an investment fails, how should I punish the business unit person responsible? Not if or who. It was literally, we went right to, we're going to do punishment. How are we going to do it? We're like, slow down, punish the venture capitalists if a deal fails. But these people need the incentive to play and to take risk. I thought that was fantastic.
But it can be really hard for the entrepreneur to unlock the organization. It's like you get, they send you there, this person leaves, or, you get dead ends, yeah. and who has the authority, and I've had some of the world's biggest companies invest in me, and some of them have been very successful, and some not, but that's often part of it. I think that it's good to have a very senior contact and a very working level contact. Because as I said, at picking American Express or MasterCard, and by the way, American Express and MasterCard both invested in me, and MasterCard bought me, and American Express allowed that, and having their money didn't prevent me from selling to MasterCard, right?
I think that's a myth. It's a myth that if you take money from one corporate, it's going to block you from selling to somebody else. I think that was the case decades ago, and it's not how the game is played now.
Yeah, and I never had a problem with it. But so if you have a senior person who says, like they said, if you really get into trouble, call us.
An escalation.
Right? And we're going to tell people they have to do it. And then there's a working level person who rolls their sleeves up and they take you by the hand and they try to get you stuff, right?
And Andrew, I think in terms of things that we've seen that have failed, lack of senior visibility and support is a huge one. So I think this relates to the question of know your why. We have a rule if the CEO is not personally involved in the CVC program, and I'm not talking about being on the investment committee because that rarely works. The CEO usually doesn't have time. Then you're going to have a failed program. And the strategy for where the corporation is going has to come from the C-suite and the board. And if this is a side project, you're going to be shut down.
Yeah.
I think the other thing that we've seen that doesn't work is trying to be a trendy investor. I think this goes back to some of the things that we're talking about here over the next couple of days. And obviously generative AI is a huge topic for people now. I love this Chinese proverb that says, the best time to plant a tree was 100 years ago and the second best time is today. But actually the best time was 100 years ago. Yeah. And if you know what you're doing and why you're doing it, then you should have been doing this already. And so, when Par was doing his panel and he, was saying there's two types of data, there's the internet and then there's the hidden data. What I thought he was going to say was there's the internet and then there's good data. Because, but we've been investing in AI for the past 5 years in legal tech for one of the largest law firms in the world, in healthcare. We work with number 10 in the Fortune 500, in the industrial categories. And there's really high quality data sets that are very specific to business applications that have proven ROI. Mm-hmm. And so these are things that made sense to do whether there was a hype trend happening or not. That would be my big advice. If you're an entrepreneur and you want to work with a corporate, know why they're doing it and what you're going to get out of them and what you can give to them. If you're a corporate thinking about doing this, why are you doing it? Not just because your peers are doing it.
And I would also add, do more, not less. I mean, for most big companies, a $500,000, $1 million, $2 million investment is literally a rounding error. So for those CVC teams, don't have the most rigorous process equivalent to Benchmark Capital or Sequoia. Right. Err on the side of spread some money around, right? Don't create these huge barriers. Just make a bunch of bets. You're going to learn at least something out of them, and some of them are going to pan out really well. And why not? It's more is more, particularly if you're trying to add intellectual or cross-pollination to your organization.
But do some diligence, please.
But FOMO is not a real strategic reason. Is that what you said? FOMO is not the right. Well, thank you both, Trevor, Scott. Thank you. This has been absolutely fantastic. Appreciate your time. Thank you, everyone.